All right, good morning, everybody. I shared this in the channel this morning. You can see that the put wall has rolled back up. You know, a lot of times when we see this, we immediately think that there's some nefarious plan behind it, or that, a lot of money came in and made this happen, but that's not always the case. Spot Gamma has said more than once that it's just a machine that goes in and looks at the current strikes with the current notional value and premiums that are at that strike. And so when we get through a 0-day expiry and it recalculates everything, looking at the new delta levels and gamma and everything else, this can happen automatically just by default. So there could have been a level down here that we saw as a put wall being rolled down, and then it expired, and now we are right back where we were. It could be nothing more than that. I'm not saying it is, but now that it got unwound, it really makes me believe that that's what happened. If we had stayed there and we consider, what's happened in the past when we've had a move down and then it went down and we had the call wall follow and we had price follow, that was a deliberate act, and we rolled it down because they were making room for price. In this situation, it happened and it was unwound. A lot of times when we see that behavior, we're just in this wash. So, you know, there's more to it than just seeing something like this and immediately thinking that some all powerful hand out there is driving everything and making these decisions with some calculated bias in mind. I'm telling you, the more I learn about institutions and funds and fund managers, retail, as much as they say that, we're the dumb money, we at least know how to trade. We have strategies. We've got multiple ways to evaluate and analyze price action, and we look at things from multiple points of view. Whereas a lot of those funds and fund managers and quote institutional players, all they know how to do is monkey see, monkey do what they were told. When A happens, do B. When B happens, do C. That's it. They don't think outside the box. They don't look around corners. And when you try to ask them any sort of questions about options or strategy or tactics, they say, oh, I have no idea. That's confusing stuff. I never learned it. All I know is when this happens, I do that. And that's it. They're not as smart as we would like to think they are. So don't set them up on a pedestal as an example of smart money, because they're not. 9 times out of 10, they're not. So the put wall has moved back up, was rolled up. And since it coincided with a heavy 0-day expiry, I'm going to just read that at the moment as just us putting the put wall back where it belongs, right? That it was just a little bit of a speed bump, and now we're there. If it had stayed low and we saw the call wall eventually get rolled down to match, that would have been something completely different. But we didn't, so it ain't, and we move on. Japan is flat, small caps right behind it. Then we get into tech, S&P, and then the Dow up the most at 0.25%. But basically, the U.S. is flat this morning. We do have FOMC minutes today. That is not FOMC. And I see this every time we're going to get minutes, that there's somebody out there running around saying it's FOMC day. No, it's not. Don't confuse the two. There's FOMC day when we get Powell out there chipping his teeth and Q&A, and then there's this day. These are two entirely different events. So it is not FOMC day. It's just minutes. Still, we are going to get information today that the market's been waiting on. So that could provide a little bit of volatility in the market. It may be what the market has been waiting on all week. I don't think it is, but no reason to go into it blindly. So, watch the clock. It's coming in at 2 p.m. So tonight we're going to get data out of Japan. I did mention this yesterday. It shouldn't come as a surprise. The numbers really aren't that wide, so not expecting too much out of it, but want to keep her focus in that direction. And at 1 o'clock today, we got the 10-year. So I always like the 10-year. I was reading an article on liquidity from end of quarter and how the Fed stepped in at the last minute. A little heavy. Now, it's a little bit of a one-off because it was the end of the quarter. They were able to match the same sort of behavior to September 2024, which is another end of quarter event. By itself, it's just a data point that we kind of want to be mindful of. But there are some liquidity issues happening right now. And with earnings coming up, banks are going to kick that off. We've already seen some volatility starting to come into the financial sector. Just keep your eye on the auctions this week, especially the 10-year today. And then, of course, we got the crude oil inventories every Wednesday. We get this. So at 10:30 today, you may have an opportunity to play crude futures, or if you don't trade futures, you could keep your eye on USO. The 10-year is getting back into the range that it belongs in. It's not excessive necessarily, but the swift move back up is a bit much, right? The rate of change is often what we need to worry about here, not necessarily what level it's at. We're seeing the move up in the dollar as well off that 96.5 level. That's going in the opposite direction of what the administration wants and what they've been working towards. So we'll see what happens with this. But, if you're watching the gold and silver move and wondering when that's going to reverse course, then just keep your eye on that dollar move. So the put wall back up above zero gamma, got to really consider the outcome here, right? If zero gamma is that line in the sand where we go from a positive dealer environment to a negative dealer environment, and their activity, if they happen to be challenged, as long as we're still above that zero gamma level, then they will buy into weakness. So if we fade down into that put wall, they're going to be buying anyways because we're above the zero gamma. But the put wall is where they would monetize their puts. Got to kind of figure that this is a significant line in the sand, and it's at that 62.50 area. One thing of concern is that we're getting all of our options levels in this really tight zone. And if we get some sort of news or catalyst or headline that does break us down through 62, through that zero gamma, and we're now underneath the volatility trigger and the put wall, the 10, the 4, the 3-week, we get underneath all of those and there's no structure underneath this, it could be a swift drop. Kind of lines us up into what flash crashes look like. Now, there's no reason to suspect that we're going to get that, but it is a threat we have to be mindful of. And the path is still clear up to the call wall. We've got these ancillary levels. All the other red lines that we see here, those are all spot gamma levels too. They're just not key levels like the put wall, the call wall, VT. And we can see that they've been defending. And if we were using OCR analysis, we would also define these as higher lows. Now, granted, we've been getting lower highs too. So we're developing a bit of a wedge. And we are compressing. Now, having an inside day yesterday inside of this really big red bar, it's not really impressive, right? Inside days that are inside a big, massive bar, pretty much worthless. We don't tend to do much with those. But today we have an inside day inside of yesterday's range, and yesterday's range is a much tighter range. This isn't a TTM squeeze yet at this point, but we are getting compressed. And this will turn into an expansion at some point. The longer we stay compressed, the more powerful the expansion will be. And if we stay compressed long enough, we will start to develop a TTM squeeze. Right now, we don't have that. We just have compression. Lower highs, higher lows, inside bars. We're IX10, and we are compressing. And the longer we stay like this, the bigger the move will be. That doesn't give us any directional bias. It's not pointing us to the upside or the downside. Just that when the move comes, it's very likely going to be significant. The ADR is 63.5. It's the average daily range. It's getting narrower and narrower as volatility slowly fades out of this market. To get to either ADR line today, we would need an inside day breakout of yesterday's range, which really isn't asking all that much because yesterday's range is a pretty tight range. If we focus just on the RTH of yesterday, then there's our 111 and 1236. The 111 lines up on the 62.91 cog line. And if we take all of yesterday, it really doesn't get much wider. but we'll take whatever it wants to give us. There's our 111 and 1236. It still doesn't even get us to the ADR half. Of course, we can run that in both directions. Yeah, and it doesn't get us there either. So just to get to the average daily range, we're going to need more than what the measurement says we can even get. We're going to need a breakout with a continuation just to get to the ADR of the day. It's absolutely possible. But what this lines up to be is that, you know, on any typical normal average day, we could break out of the previous day's range and just wick out and come back in again. It's not really a big deal. We wouldn't be looking for continuations or anything like that. This says we can't even get to our average daily range unless we do get a continuation play. Regular market dynamics won't get us there today. Today's floor pivot is lower than yesterday's. That's bearish. Price opened above it. That's bullish. They sort of cancel each other out. This is a very narrow channel on today's price. In fact, it's so narrow you don't even see a channel. You just see the purple line. But if I zoom into it, we will see that there's a very narrow channel there. A narrow channel implies that if we do break out, that it could stick and we could have a really nice run. Now, what that looks like, generally speaking, would be breaking out of the previous day's range and then getting somewhere. So that's yesterday's range. This very narrow pivot point channel says that if we break out to the upside, we could keep it, or if we break out to the downside, we could keep it. It doesn't make price break out. It doesn't hold us back from breaking out. And if it does break out, it doesn't keep us broke out, right? This is just a tool to consider. If we did break out, what's price supposed to do with it? Now, because of the narrow day that we had yesterday, the S&R levels are going to be a lot closer. We're nearly at R1 already. The concern is that we're going to get an R1 S2, and S2 would line us up at 62.37. There's nothing really bearish in that statement, although obviously it's pointing to the downside. It's just a mechanical function, right? If you get to R1 and stall out early enough in the day, you can reverse and play the strategy from an R1 to an S2. But if we get to R1 and get above it, then that gives us R2, and that's what we would target next. And really, that R2 lines up closer with today's ADR half. We just got to get above R1. So 62.92 cog line. It's really close to the week's pivot point. If we can get through that, then it lines us up for an R2 and the ADR half. And we are back above that, the midpoint of Monday's price action. Got a much cleaner distribution at this point than we had yesterday. The value area has really tightened up, and we're back there again this morning. If we can get through that value area high, then we've got this previous lump to deal with. A little bit of a footprint back here. 6,300, we would have expected to have more of a footprint. But when you look back at the previous week, we really didn't leave much behind back there, and we didn't put in much this week. So there is a little, yes, but not a lot. It's interesting to note as well that last week they didn't front run it. They actually waited until we were above 63 before they really started to come in. But this week they did front run it, and it got a bit shallow once we were above it. At the end of the day, one way or the other, it doesn't really matter. It's just a bit of a note, on whether they're front running or not. 10-day, 30-minute volume profile and TPO. The point of control still matches on both of these, but the value area does not. We're still looking for the value area on the volume profile to come up and match. That should give us around 6,200. And it's very likely going to happen at some point today or maybe into tomorrow. You can see that the candles that made this volume still exist. And we're not going to get there for a while yet. It does look like we're close to getting a new profile. So if we just get this moved up a little bit into this new zone. Same thing with the TPO's point of control. So it's not a significant shift, but we spent, half of a week or better building out the volume that made this current point of control. And at our new location, we did get some work in back here and a little bit here. Those three spots have laid out this current level of volume. So if we get a trip back down today, it's likely we'll see this point of control move up. It's going to move up there one way or the other, right? The question is it going to take another week as we eliminate all of these candles before we start wiping these out, which automatically removes the volume? Or are we just going to put in enough work that we bring it up to our current location anyways? It's going to be one or the other. I'd rather have it move up to it while we're still here rather than getting some sort of rejection and we end up getting below it. The concern is we've been getting these lower highs and lower lows. We're setting it for a downtrend. And if we remove this structure here and it's no longer underneath us to help us out, and instead it gets rolled up, now it's some level that's over our head or even just at our location. It won't be a dynamic that is helping us out at that 6,250 level. And that'll be concerning. One more structure that's not down there to help us out. No new VPOC from yesterday. We've already hit that level and wiped it out. Not a lot here that's offering much insight. Double distribution is kind of nasty and nothing really shines a light. We spent a lot of time down here. It makes sense that the point of control is there. And now we're hanging out here and the point of control is very likely going to move up into that point soon. It's just not helpful. So at GTFO, we got to get out of the box, get outside of yesterday's range and begin this expansion at some point. Still within the week's expected move. We haven't reached the edge and we're not back to Friday's close. So not getting a lot out of that. We're still more than 3.5% above the 10-week. We're on the decline after getting a bit stretched. But at this point, when we look back at being at this level, we can see that we've spent a lot of time here before. We're not overbought. We're not overextended. It doesn't owe us any sort of mean reversion. It's still a little hot. It could cool off a little bit, get down into 3.5 or maybe 3%. But it's just a slow fade at this point, and that's exactly what we want. Because as I've mentioned before, there's two ways that we leave these sorts of elevations. And one, it happens really fast, or two, we slowly grind our way back down again. Obviously, the slow grind back down would be preferred, right? Rather than seeing a 2.5, 3% drop in a single day. We don't know which one we're going to get, but it's what we need to be mindful of, that if we do start a swift descent, that we could easily move 3.5%, and we wouldn't even be back to the 10 at that point. We'd be close to it, but we wouldn't be back to it. And for the 10-day, we're less than 1% above the 10-day. We're sitting in this zone. It's really comfortable. We're not overextended or overbought. This is exactly where you would want to be. Just a little above the 10, maintaining a steady run. All good. China is down again this morning. And really, that's the only thing that we have down. China and the VIX. Looking at what's up. Really, out of all these that we see that are up, it's the ones that are above 0.5% is the ones that we want to focus on. And we've got a little bit in there, quantum, but these are not the sectors you want for a rally day. That would be SMH and Mag 7 and Bitcoin and financials, and they're not up 0.5%. So we don't have the sectors we need for a rally today at this point. They're not negative, they're just not up enough. Solar got whacked, especially with some talk out of the current administration. So not a surprise there. Uranium also got whacked, and then China. Gold still soggy with the moves in the dollar. Silver is less weak. It's a little bit of a disparity there. And the sector that's up the most is pot stocks. You don't want a rally day based on pot stock. That's not sustainable. USO, I mean, we're going to get the oil inventory today. So it's possible we get something out of this. Just be mindful of this big bar here, right? Like a liquidity gap. If we can get through the midpoint of this bar, we can get back to the top of the bar. That's a big if, and it's a really big bar. But it could turn out to be a nice play. This generally, has it's a cheaper stock. It's got, cheaper options. It's not overly liquid, but it should get the job done if you don't want to do crude futures. So it's simple enough for today. watch the headlines, get out of this box, and then play what we get. If we get a break to the upside, we got to get through Monday's high and then Friday's high. Got ADR levels to the upside and floor pivots to play as well with the R2 and R3. To the downside, break our Globex low, get through Monday's low, and then focus on last week's low as the next target. And of course, we've got the measured moves with 111s and 1, 2, 3, 6. Once we get into our own trading day and we have regular trading hours candles that we can measure after we get the breakdown, right? And you can measure Monday's bar. If we do get a breakdown or a breakout above or below Monday, you can put the fibs or the quadrant lines back on Monday and use that 111 and that 1, 2, 3, 6 on either side as targets as well. I think it's likely that we have a very boring day with no breakout. Hopefully that's not the case, but just, be prepared for that, because if FOMC minutes is not what they're waiting on today, then we're not going to get the breakout today. We're going to stay in this hurry up and wait mode for another day. I don't think that's going to be the case, but we'll see what we get. Everybody, be careful, be safe. I'll see y'all tomorrow.